You know that weird feeling you get when you check your bank account and realize you've been working for like 5, maybe 10 years, and somehow you still don't have anything that makes money for you? Like all your effort just goes into paying bills, buying groceries, maybe saving a little bit here and there, but nothing's actually working in the background while you sleep. It's this quiet panic that creeps in at night when you're lying in bed, scrolling through your phone, seeing other people talk about passive income and financial freedom, and you're wondering, when does that start happening for me? When do I get to stop trading every single hour of my life for money? And here's the thing, most people never figure this out. They spend decades waiting for some magical moment when everything clicks into place, when suddenly they'll have enough saved up to invest, or the right time will appear, or they'll finally understand how the stock market works. But that moment doesn't just show up. My name is Synth, and I spend way too much time thinking about money, financial psychology, and why some people seem to build these incredible income streams that keep growing year after year, while others stay stuck in the same exhausting cycle of work, spend, repeat. And what I've realized is that building dividend income, like real, meaningful dividend income that actually changes your life, isn't about getting lucky or having some massive pile of money to start with. It's about understanding a very specific 10-year pattern that almost nobody talks about in a realistic way. Because here's what's wild. If you can commit to a 10-year plan right now, like genuinely commit to it, you could be looking at a completely different financial reality by the time you're done. Not some vague promise of wealth, but actual monthly checks showing up in your account from companies you own pieces of. And I'm going to walk you through exactly how that works, what it actually looks like year by year, and why most people completely misunderstand the timeline and end up quitting way too early. Okay, so let's start with the part that nobody wants to hear, but everyone needs to understand. The first few years are going to feel completely pointless, like brutally, frustratingly pointless. You're going to be putting money into dividend stocks, watching these tiny little payments trickle into your account, maybe $12 one month, maybe $38 the next, and you're going to think, this is it? This is what everyone's hyping up? And honestly, yeah, that's exactly it. Because dividend investing in the early stages isn't about the money you're receiving. It's about building the snowball before it starts rolling downhill. Think about it like this. Imagine you're planting an apple tree in your backyard. Year one, you're just staring at this sad little stick in the ground. You're watering it, making sure it gets sunlight, and you're getting absolutely nothing in return. No apples, no shade, just a stick. Year two, maybe you get a few leaves. Year three, some branches. But you're still not eating apples. You're still just waiting. And most people look at that tree around year 2 or 3 and go, you know what, this is stupid. I'm cutting it down and planting something else. But the people who actually end up with apple trees, the ones who eventually have more apples than they know what to do with, they're the ones who just kept watering the stick. Dividend investing works the exact same way, except the timeline is even longer and the payoff is even bigger if you actually stick with it. So here's what a realistic 10-year plan actually looks like, broken down year by year, because I think when people see the full picture, it makes a lot more sense why patience is basically the entire game. Let's say you're starting with $1,000 and you're adding $500 a month into dividend stocks. Totally realistic numbers for someone who's serious about this, but not like already wealthy. By the end of year one, you've got about $7,000 invested, and you're probably earning somewhere around $200 a year in dividends. That's less than $20 a month. You could make more money selling old clothes on Facebook Marketplace.
But here's what's happening beneath the surface that you can't see yet. You're building positions in companies. You're learning how dividend stocks actually work. You're starting to understand yield, payout ratios, dividend growth rates. You're making mistakes. Maybe you buy a stock with a crazy high yield that ends up cutting its dividend, or you panic sell during a market dip. But those mistakes are teaching you. And most importantly, you're developing the habit. You're automating the contributions. You're getting used to seeing red days and not freaking out. By year 3, if you've kept that same pace, you've now got around $20,000 invested. Your annual dividend is probably somewhere around $600 to $800. Still not life-changing, still not quitting your job, but you're starting to notice something. The dividends you reinvest are buying more shares, which pay more dividends, which buy even more shares. The compounding is starting to whisper to you. It's not shouting yet, but it's there. And this is where most people quit, because 3 years feels like forever when you're only making $70 a month and the stock market inevitably has a bad year in there somewhere. And you start thinking, maybe I should just use this money for a vacation or a new car or literally anything that gives me joy now. But if you quit here, you miss the entire point. Okay, so you didn't quit. You kept going. By year 4, you're sitting on around $30,000 invested, and your dividends are now over $1,000 a year. You're getting close to $100 a month in passive income. And this is where something psychological starts to shift, because $100 a month isn't nothing anymore. That's a phone bill. That's groceries for a week. That's a tangible thing. And because you've been doing this for 4 years now, you're also way better at picking stocks. You've figured out that you don't want super high yields if they're unsustainable. You've learned to love boring companies that just keep raising their dividends every single year, like the companies that make toothpaste and sell insurance and produce food. You've realized that dividend growth is actually more important than dividend yield, because a 3% yield that grows by 10% every year is going to absolutely destroy a 6% yield that never grows. By year 6, you've got close to $50,000 invested. Your annual dividends are probably pushing $2,000. You're making $150, maybe $200 a month just from owning stocks. And here's where it gets interesting. You start to see the compounding in real time. Every quarter, you're reinvesting those dividends and buying more shares, and those new shares are immediately paying you more dividends. It's like watching a flywheel start to spin faster and faster. But you're still not rich. You're still going to work every day. You're still living your normal life. And honestly, that's fine, because you're not trying to get rich quick. You're trying to build something that lasts. This is where things get genuinely exciting. By year 7, you've got around $70,000 invested, and you're earning close to $3,000 a year in dividends. That's $250 a month. And if you've been smart about picking dividend growth stocks, some of those companies have been raising their dividends by 5, 8, even 10% every year. So the stocks you bought back in year 1 are now paying you way more than they were when you first bought them. Year 8, you're pushing $90,000 invested. Dividends are now around $4,000 a year, over $300 a month. You start doing the math in your head. If I keep this up for another 10 years, I could be making, wait, how much? And the answer is usually shocking, because you're starting to see the exponential curve.
By year 10, if you've stuck with the plan, $500 a month, every month, reinvesting dividends, staying consistent, you're looking at around $80,000 to $100,000 invested, depending on market performance. And your dividend income is probably somewhere between $5,000 and $7,000 a year. That's $500 a month, maybe more. And this is passive. This is money showing up in your account because you own pieces of companies that are profitable and share those profits with shareholders. But here's the part that blows people's minds. That $500 a month isn't the finish line. It's the launch pad. Because if you keep going for another 10 years at this point, you're not just adding your $500 a month anymore. You're also reinvesting $500 a month in dividends. You've doubled your monthly investment without increasing your own contributions. The snowball is rolling on its own now. And honestly, I think this is where a lot of the confusion comes from when people talk about dividend investing. Because when you hear someone say, "I make $10,000 a month in dividends," your brain immediately goes, "Okay, how much money do I need to do that?" And the answer is usually something like $2 to $3 million invested. And you think, well, I'm never getting there. This is pointless. But that's not how anyone actually builds dividend income. Nobody wakes up with $3 million and dumps it into dividend stocks. They start with 1,000, then 10,000, then 50, then 100. And the timeline is long, but it's not impossible. It's just patient. And patience is the thing we're all terrible at, right? We live in a world where everything is instant. You can order food and have it at your door in 30 minutes. You can watch any movie ever made right now. You can send a message to someone on the other side of the planet and get a response in seconds. But wealth? Wealth doesn't work that way. Wealth is the apple tree. You plant it, you water it, and you wait. Now, let's talk about what actually goes into the portfolio during these 10 years. Because just saying buy dividend stocks is like saying eat healthy, technically true but completely useless without specifics. You want a mix. You want some high-quality dividend aristocrats. Those are companies that have raised their dividends every single year for at least 25 years. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These are the boring, reliable, I will never get rich off these, but I will also probably never lose my shirt stocks. They're the foundation. Then you want some dividend growth stocks, companies that maybe don't have the longest track record, but they're growing their dividends fast. Think tech companies that have started paying dividends, or healthcare companies, or even some financials. These are the ones that could turn a 2% yield into a 6% yield on your original cost after 10 years, because they keep raising the payout. And honestly, you probably want a little bit of exposure to REITs, real estate investment trusts, because they're required by law to pay out most of their income as dividends, so they tend to have higher yields. But they're also more volatile, so you don't want them to be your whole portfolio. The exact mix depends on your age, your risk tolerance, your goals, but the principle is the same. You're building a collection of cash-flowing assets that pay you over and over again, and you're reinvesting those payments to buy more assets. And here's something nobody talks about enough, the psychological shift that happens when you start receiving dividend payments. Like the first time you get a dividend check, even if it's $15, there's this weird little thrill because you didn't do anything to earn that $15. You didn't work an extra hour. You didn't sell anything. You just owned a stock and the company said, "Hey, we made money. Here's your cut." And that $15 is proof of concept. It's proof that this whole thing actually works. And then, over time, you start to see your money differently. You stop thinking of your net worth as just a number in an account and start thinking of it as a machine that produces income. You start asking yourself, if I buy this thing, how many months of dividend income is it going to cost me? A $2,000 vacation isn't just $2,000 anymore. It's 4 months of dividend payments. And maybe you still take the vacation, you should, but you think about it differently. This is what financial independence actually feels like before you're financially independent. It's the shift from I trade my time for money to I own things that make money. Let's talk about the mistakes, because you're going to make them and it's better to know what they look like ahead of time. Mistake number 1, chasing yield. You're going to see a stock paying an 8, 9, 10% dividend and you're going to think, why would I buy something paying 3% when I could get 10? And the answer is because that 10% is probably unsustainable. High yields are often high because the stock price has collapsed, and the stock price has collapsed because the company is struggling. You buy the 10% yield, the company cuts the dividend 6 months later, and now you're stuck with a loss and no income. Mistake number 2, panic selling during downturns. The market will drop. It always does. And when it drops, your dividends will probably stay the same or even keep growing. But your account value will shrink, and you'll feel like you're losing money. But you're not. You're buying more shares at lower prices, which means higher yields on your new purchases. The best dividend investors I know get excited when the market crashes because everything goes on sale. Mistake number 3, not reinvesting dividends in the early years. Look, I get it. Getting $100 in dividends and actually having it hit your bank account feels good. But if you spend it in years 1 through 5, you're destroying the compounding. You need those dividends to buy more shares. That's the whole point. Once you're at year 8, 9, 10, and you're getting meaningful amounts, sure, spend some, enjoy it. But early on, every dollar you reinvest is worth $10 later. So where does this leave you after 10 years? If you've done this right, if you've been consistent, if you've reinvested, if you've stayed disciplined through the boring years and the scary years, you're looking at a portfolio that's producing real income. Maybe it's not enough to quit your job yet, but it's enough to feel different. It's enough to cover your car payment or your rent or your grocery bill. It's enough to know that if something happened to your job, you wouldn't be starting from zero. And more importantly, you've built the foundation for the next 10 years. Because if you keep going, the compounding doesn't just continue, it accelerates. The second 10 years will produce more income than the first 10 years by a massive margin. The math gets ridiculous in a good way, but you have to start, and you have to stay. Here's the truth that I think people need to hear. Building dividend income is not sexy, it's not exciting. You're not going to have some viral moment where your portfolio explodes overnight. You're going to have a decade of quiet, consistent, unglamorous investing, where most days nothing happens, and the only thing you have to show for it is a slowly growing number on a screen. But that number represents something real. It represents freedom. Not the kind where you're lounging on a beach sipping cocktails, but the kind where you wake up one day and realize you don't have to take the job you hate. You don't have to stay in the relationship that's draining you because you can't afford to leave. You don't have to say yes to every opportunity just because it pays. You have options. And options are what money actually buys. So if you're sitting here wondering whether it's worth it, whether 10 years is too long, whether you should just spend the money now and deal with the future later, I can't make that decision for you. But I can tell you this. 10 years from now, you're going to be 10 years older no matter what you do. The only question is whether you'll be 10 years older with a portfolio that pays you every month, or 10 years older wishing you'd started today. The apple tree doesn't care if you plant it or not. It's just a tree. But you might care 10 years from now when you're still staring at an empty backyard. Start planting.